It's great to be here, and to the organizers to say thank you for inviting me. I was asked to discuss this question: how central banks can facilitate the development of a better stablecoin. But in some sense, and honestly, then I don't think central banks should facilitate stablecoins or support them in some sense. And I'm going to explain why. The reason is basically that, let me see. The reason is basically that national currencies are not just a piece of paper or a digital representation of money. They are not. They represent the monetary system, and a monetary system is vital and important for every economy. And money is always and everywhere a legal concept. That's just a fact. So when we're talking about national currencies, we have to be careful. And we also have to remember that without regulation, oversight of central banks, central bank lending facilities, central banks as lenders of last resort, deposit insurance schemes, and so on, bank deposits that are essentially just IOUs, they would be defined as bad money. Bank deposit would be defined as bad money, as described by the Cornell professor Dan Avray. So it's due to the society's safety network for banks that we can talk about bank deposits as good money. They are safe in some sense. So we have to think about regulation, which basically transforms risky IOUs, which are bank deposits, into relatively safe assets or good money. But now, for the first time in history, we are able to transact and store real money on-chain without the intermediation of financial institutions such as banks. This is the great opportunity that we have. But still, it is important to remember that it is regulation that makes bad money, bank deposits, good money. So what we need is that we need to have stable coins regulated. That's what we need. Because by definition, stable coins are IOUs, and in that sense, bad money. This is not revolutionary. This is what we have done before. This is what is needed. And this is what is needed for using the opportunity that Web3 is offering us. Now, much has been said about the US. As we know, there is currently no specific regulatory framework for stablecoins in the US. And the lack of regulation has led to disagreements and legal uncertainties between stablecoin issuers and regulators. And this is a bad thing because the US dollar is, after all, the most important currency, the most important national currency in the world, and it is the reserve currency of the world. But because of this uncertainty in the US stablecoin holders are left in legal no man's land. On the other hand, Europe has already established regulations for digital money tokens. The concept of e-money was first introduced in Europe in the year 2000, 23 years ago. So it makes it a well-established framework for over 20 years, and it serves as a digital alternative to cash and has primarily been used for money on cards. And it is intended to be technically neutral form of money that can act as electronic surrogate for coins and banknotes. That was the intention 20 years ago. The European central banks the European Central Bank recognizes billions of euros as e-money issued by major financial institutions as overnight deposits. And the company that I co-founded, Monerium, became the first company to be licensed to issue euro as a token on blockchain already in 2019. That is a digital euro token. And this demonstrates that the legal status of e-money under EU law has been clear for more than 2 decades. And under EU law, then issuing a digital representation of a national currency with a claim against the issuer is just defined by law as e-money. And it's also stated that only licensed and regulated e-money institutions authorized to do so can issue e-money. So it's quite clear and has been clear for those 2 decades. It basically means that euro stablecoins that fall under this definition, but without the legal status as e-money issued by a licensed and regulated EMI, is not aligned with EU law. So that's why I say that EU central banks, in some sense, cannot and should not facilitate stablecoins directly, but the task is to make sure that they will be regulated if they want to be a digital representation of national currencies. Now, if we shift our focus a little bit and think about a nation state or a currency area, then it is powerful for a nation to have a trusted and widely used national currency. It can strengthen the nation's geopolitical power, and it can facilitate economic prosperity. We know this. The US dollar is a prime example. They are privileged in the US to have the US dollar. So it should come as a little surprise that history is full of examples of currency competition between nations and now between different kinds of currencies. So then we have to ask ourselves, what is it that makes a national currency popular and widely used? Number one. And number two, how can we ensure popularity or increase the likelihood of popularity and usage? Every nation, every currency area, every currency, or those in managing currencies should ask these questions. So I say, well, regulation is crucial. The US needs to step up its game and provide clear guidance and regulation for money tokens. Just yesterday, we saw that the SEC declared that BUSD stablecoin is a security. This is not helpful. This is really, really not helpful. However, the latest draft bill in the US, now being discussed, could create a competitive advantage for the US dollar over the euro as tokens. Because the US bill would grant stablecoin issuers access to the Fed's deposit facility, the central bank facility, and thereby removing the risk associated with keeping funds within the fragile banking system. And if you have read the consultation paper from Bank of England, then similar ideas are circulating there. Basically to give stablecoin issuers access to the central bank, and that is through that would be through something what we would term as wholesale CBDC. Now, in contrast, MiCA, the Markets in Crypto Assets proposal here in Europe, does not provide the same level of access to central bank deposit facilities. Furthermore, MiCA mandates that at least 30% of safeguarded funds is to be held at commercial banks. And this goes against the core ethos of the Web3 technology, which basically says that we want to be able to transact, send money, and safeguard money without the intermediation of financial institutions such as banks. So as you can hear, I'm not, for this part of MiCA, I'm not so happy. So I say yes, regulation is crucial, but it matters how the regulation is, and we shouldn't accept any regulation. I actually believe that regulation, just as technical and business innovation, is best served by competition. So the currencies of the US, the UK, the euro area, and other jurisdictions will compete based on its legal framework, governance, and technology. I believe that competition is a catalyst for growth and progress. It challenges the status quo and drives us to find better ways of doing things. Free markets with healthy competition are typically the most efficient way to provide people with the goods and services that they desire. So I say to central banks that they should embrace competition and ensure that their currencies are offered in a regulated, safe, and fair manner where private companies compete in the market in technical and business innovation. A CBDC or a CBDC equivalent does not have to be offered by a central bank. It may serve the currency better if the central bank removes itself from competition. And in this context, I would like to remind you that even notes in the UK, some of them are issued by the Bank of England, the central bank in the UK, but 6 other banks, private banks, are allowed to issue notes of the sterling in the UK. But that is done under regulation, and it makes it sound and good money. But if the central banks will move themselves out of the competition in the retail CBDC era, then I believe it will encourage more investments into this business, and technical payment innovation will then flourish better and thus facilitate competition that is, in my mind, likelier to lead to a better solution. And I don't think in any term that central banks should position themselves as direct competitors in the retail payments space. It is not the role of central banks to drive business and technical innovation. And also, if a central bank were to compete, it would create a conflict of interest when it comes to regulating and monitoring its competitors. Central banks can facilitate the development can best facilitate the development of the digital currencies through what I would believe is a public-private partnership. So in conclusion, I would like to say that we are on the verge of a new era of a fierce currency competition, not only between nations and national currencies, but also other forms of money. And those currencies, national currencies, aspiring to be widely used and competitive, must prioritize the facilitation of sound public money and encourage competition on all fronts. Merely discussing the idea of central banks offering retail CBDC can hamper investment. And if you hamper investment, you're hampering competition and you are decreasing growth and innovation. The European Central Bank is vocal about its digital euro project, but I believe that supporting private-public partnership, where the central bank is offering wholesale CBDC and making sure that stablecoin issuer can preserve or safeguard the underlying assets in a safe way, would be more beneficial and create better results. And don't forget that the digital euro as a token already exists. It was first issued in 2019, and it was by a company called Monerium. So to foster competition and provide a euro that can compete on the global stage, the ECB should back the euro by granting e-money issuers access to the bank's deposit facility, as is the case for commercial banks. Equal backing by European Central Bank would create a level playing field and facilitate competition and growth. Thank you.